Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. We are recording this on April 24th. Hope everybody is doing well. Ernest Wong, thank you for joining me today. Before we get started, we'd always love to get your feedback. We've upgraded our technology a little bit on the podcast, so let us know if you like the new look. By the way, if you like this podcast, please subscribe on Apple, on YouTube, on Spotify. Please, we really like your 5-star reviews. We really like all your comments and feedback, and let's keep this going. Ernest, we are going to talk a little bit about tariffs, but in a different way today. Talk about what companies are actually saying as we're starting to get the Q1 reports in. Q1, for those that know, ended at the end of March. The tariffs kind of started to kick in April, so companies are obviously reporting April and May, so there'll be some impacts from the tariffs. They'll tell you what their customers are saying, their suppliers are saying, so at least we get a little bit of insight as to how bad it's going to be. Could it get worse? I think the answers to all those things are yes, but or maybe not, but we'll see. We've got a rundown of a number of our companies that have reported earnings. I mean, Ernest, for the most part, this earnings season has been quite strong. From what I've read, companies are beating earnings guidances by a fair bit. There are a few surprises, of course, and companies obviously, are talking about the major issue, which is tariffs. There's always something, right? Last year was inflation.
Election uncertainty.
Yeah, election uncertainty. The previous year, it's inflation or recession, pandemic. I mean, there's always going to be challenges to the business, any business. And where companies shine is how they adapt to the changes, how they are able to get ahead of some of the problems and really be able to provide their products and services to their customers like nothing has changed. And that's the sign of a beautiful operating business. So today we're gonna talk about a trucking company, which is probably not the best place you want to be in during tariff times, but looking forward could be a wonderful place to be. And we'll cover Netflix's earnings. We'll cover some other companies. So yeah, let's just get right into it. Ernest, you started to see some earnings come out from our companies. High level, what are you thinking? About our portfolio right now?
So, as you mentioned before, this earnings period is covering January to March, end of March.
Yeah.
So, Liberation Day, which was the day that Trump announced all the tariffs.
Yes.
That came on April the 2nd.
April 2nd.
Yeah.
Okay.
So it happened after the period that these companies are reporting for.
That's right. And then,
but then, today is the 24th.
Yeah.
So companies have had about, give or take 3 weeks worth of observations in terms of what they're seeing in the marketplace, what customers are talking about, what is consumer demand looking like. So there is some, I think, pretty good color about how all of the headlines that you're seeing is impacting business on like a day-to-day basis.
And of course, Trump put a pause on those reciprocal tariffs, except for China, about a week later after Liberation Day.
No, I think it's a little unclear exactly how this is, like, what exactly is going on.
Yeah.
And I'm not saying that just from like an analyst perspective. It seems that like companies certainly don't know what's going on. Countries themselves don't know what's going on.
Yeah.
I think Japan was saying they couldn't reach a deal because like they just didn't. So they went to the White House or they talked with the Trump administration, and the Trump guys said, "Okay, we want a deal." Japan said, "Fine, what do you want?" They said they weren't able to tell him. right? So
Yeah, of course we're getting our news from Twitter, and
right.
the flip flopping headlines are driving people insane. Our business partner, our chairman David Baskin said, in the short term right now, it's like it's very uninvestable, and that's true. But don't worry about the short term. The long term is what we want to focus on. And I tweeted this the other day. It's like the short terms are what provide long-term investors like us the great opportunities, either to buy more names for your portfolio or switch out to something better. And there's always going to be something, whether it's relevant or not relevant. That's another story. Obviously, these issues are relevant. The tariffs, as you said, will start to kick in or are kicking in now. And so I let's just get right into it.
I think one other thing I would say is that I think, like, kind of regardless of your personal feeling towards Trump or the sloppy execution of the tariffs or whatever, if you're a company, you don't have the luxury of philosophizing about these things. Like, you have to deal with it on a real time basis, right? So that's the reason why, like, I much prefer, reading about company earnings and seeing what they're seeing on the ground versus, reading like a newspaper headline about this is why the global world order is shifting away from American exceptionalism or whatever, right?
And we're not focused on only our companies. You're reading transcripts and looking at conference call notes about other companies and all different types of industries to get a good sense of what companies, especially the big Fortune 500, S&P 500 type companies, are saying about the world. We're significantly invested in the U.S. We have to know what's going on.
And so, like, if you are Watsco, for instance, like, it's a company that we own in our portfolio. They're a distributor of like HVAC systems. The CEO of Watsco is not really sitting there thinking about whether, like, the status of the U.S. reserve currency is at risk, or whether American exceptionalism is starting to decline. Like, he's dealing with whether like the cost impacts of tariffs on air conditioner systems.
That's right. And
like, that's what he's thinking about. He's not thinking about all these big picture macro things.
And they have the data every day to know how many air conditioners are probably going to need replacing or need fixing over the next year, population growth, how old the inventory is of air conditioners in the United States in their specific areas. And they need to order those products. They need to have them on, and unless we're going to have another supply chain crisis like we did out of the pandemic, God forbid. I mean, hopefully these tariffs and this uncertainty ends quite soon.
And then one last thing I would say is that, obviously the situation is not ideal for companies. Like, they'd rather not have to navigate tariffs, but that's just what business management is. Like, the business conditions are never going to be perfect, right? It's the job of the CEO to kind of navigate through these things and to respond to ensure that you're conducting business properly. So that's what's kind of going on.
Okay, so what do you want to talk about? Watsco? Do you want to talk about?
TFI? Sure. So I think one thing is that most of the companies that we follow and most of the hopefully all the ones that we own are good companies.
Yes.
Right? Like, these are kind of by definition, a good company is one that, has the ability to raise prices. They have the demand is going to be a little bit more resilient in weak times. And so we might not be getting like a complete picture of what everything is totally going on with regards to tariffs. But I think generally speaking, things are quite resilient.
Yeah.
Even if, people are feeling a little bit nervous on the edges about the things that are going around in the world.
It really hasn't shown up yet in the economic data coming out. Clearly, it's showing up in surveys or those that consumer confidence things. No question, it's everyday news. You watch any program, any news program, business program, it's tariff talk, right?
Yep.
So it makes people nervous, and most of the world doesn't even know what a tariff is. but they will feel the impact, of course, if some of these go through and stay for a long period of time. So Watsco, HVAC company, where does it get most of its parts from?
Well, I think they source most of their products from the OEMs, right? The OEM is often the one that is, kind of responsible for setting the price in response to things like tariffs.
So an OEM is a carrier or a train. Those are the
Ream, yeah.
Those are the manufacturers, the brand owners of those HVAC companies, and they use Watsco as a distributor.
Yeah. And so the way it works is, Carrier would make the air conditioner. Mm-hmm. They would sell it to Watsco. Then Watsco would sell it to the contractor who is going to install it in your house. And Carrier and the other guys have been raising prices. Some of that is like they were going to raise prices anyways, but they've especially done so because of tariffs.
I assume there's aluminum in HVAC. Yeah. I don't know if there's steel or maybe a few ball bearings, what have you. Yeah, I mean, so
they make them in Mexico largely. Yeah. Mm-hmm. So I think still a little uncertain about how that all plays out, but they are raising prices, and Watsco is passing those prices on to contractors who are passing them on to people who are, wanting to replace their air conditioners.
So Watsco's stock actually got nailed on yesterday when it reported earnings. Stock was down about 7 or 8%. A lot of it really just has to do with maybe poor seasonal results for its HVAC products.
Yeah.
Not so much tariffs.
Yeah, so Q1 is always a lighter quarter for Watsco in the sense that most people don't really replace their air conditioner until spring or summertime.
Yeah, I mean, I'm not running my air conditioner in the winter. Of course, we live in Toronto, Canada, where it's been freezing the entire winter. But
there were certain pockets of its business that were a little bit weaker. So the new construction segment, so selling to builders and developers, that was a little bit weaker. Commercial was a little bit weaker. International, like Canada and Mexico, was a little bit weaker. But by and large, things are all right. And I think there was a little bit of chatter about why those specific end markets were weak and whether that could spill over into the spring and summer selling season.
And commentary on tariffs or the consumer from Watsco?
No, I think they said it's just business as usual.
Yeah.
So I think the one thing about Watsco is that amidst all of the tariff talk, they're currently navigating a change towards an industry-wide change towards higher efficiency systems. Basically, the EPA is phasing out a certain type of refrigerant that is worse for the environment.
Yeah.
And so as Watsco basically has to get rid of all the old systems, bring in the new ones, and there's been a little bit of not to say disruption, but they've had to navigate through that. Mm-hmm. But big picture, it's positive for the business because these new systems are, number one, they're more expensive. So as a distributor, they're making more money. And number two, they are, they make it harder for you to repair a broken system because they don't connect to they don't have the refrigerant. Yeah. So if your air conditioner breaks, you're going to have to buy a new one.
So for those that don't know, Watsco is a distributor of HVAC parts, primarily to contractors, those nice men and women who come and fix your furnace or your air conditioning when it's broken. Some of us can do things on our cars ourselves. Some of us can fix.
Not me.
Yeah, but I'm just saying there's
our trader can though.
Yeah, or have the special powers to do grouting or some simple jobs. Not me. My wife actually has some of those powers. But
no. But I think the important thing to know is that what Watsco is saying is customers are not replacing their systems just because of tariffs and price increases. Right. Yeah. And it makes sense, right? Because if your house is hot,
I don't know,
you're going to need your air conditioner.
If you live in Florida, and so Watsco sells a lot to those Sun Belt states. You need your air conditioner. It's not getting any cooler. So that's the Watsco thesis. We'll see how the year plays out for Watsco. As Ernest talked about, the company's very excited about the transition to this new air conditioner, new regulations that should force upgrades for many years.
So one thing I want to point out about Watsco, and it's kind of a bigger picture, is that before after Trump got elected, I think there was a lot of the narrative was that he was going to pull back on regulation. It was going to be Wild West. You can basically kind of go do whatever you want,
I mean,
right?
in some areas it might be, but yeah.
In some areas, I think like the credit card fees
Yeah.
and cryptocurrencies and those kinds of things. I think definitely Trump has pulled back on regulation.
Well, for sure.
But
you want to win a dinner with Donald Trump, just buy a lot of Trump coin.
yes, I saw that.
Yeah. Okay.
But in many other areas, so the EPA being the Environmental Protection Agency being one of them, I think Watsco talked about it. Another company we own, Waste Connections, has talked about it. I think they're not seeing any pullback in regulation, at least not yet.
All right. So it hasn't taken place.
And that's true even for things like antitrust, where I think people were hoping that antitrust was going to, like they were going to pull back, make it easier for you to do deals, right? That certainly hasn't happened yet.
Business as usual.
Yeah.
A lot of talk, less action, of course. A lot of action, of course, on the tariffs. TFI International stock, of course, one that we've held for a long time, one that got absolutely hammered last quarter, before even tariffs were even a thing. I guess people were talking about them, and that might have created some uncertainty. TFI has been a shipper of shipping, trucking business. That's been a tough market for a number of years. TFI stock is held up nicely because they're great allocators of capital, but
today at least.
But but the last quarter, Q4, just this company stock took a drubbing as it really lowered its guidance and saying this is going to be a tough year. And that was even before, of course, tariffs, with these gigantic reciprocal tariffs and the trade war escalating with China. So what did TFI have to say on its call? I see the stock is up about 5%. So that's a welcome change because the company did not report great results.
Well, and I think it goes to show you that it's one thing to say, well, things are going to be bad, right?
Yeah.
But that doesn't mean the stock is necessarily going to go down because maybe it wasn't as bad as what everybody thought it was going to be.
That's right. Or the stock is already, we always have to keep in mind, the stock market anticipates months in advance these results, right? And so the market, by nailing TFI stock almost 50% over the last 3-4 months, you got to admit a lot of the bad news is already priced in.
No, and I think do I wish we sold TFI before it fell 50%?
I wish we did.
Yes, we did, right?
Yeah.
But we've owned TFI since, I want to say 2004,
Yeah.
well before I joined the firm. And even through, if you go back and look at what we bought it for from the very beginning through to today, after the 50% drop, I think we still had a pretty good return. And that's because, that's the power of compounding, right? Of generating a business that has a lot of cash flows that over time continues to do smart things, even if things may not be necessarily going well every single quarter.
Yeah.
And I think for this quarter specifically, I think it's very classic TFI, where yes, the environment for shipping goods is not good.
Not good. We don't know exactly what's going on, but we can assume that there's going to be fewer orders from China until 145% tariff goes away, or at least is reduced dramatically. And if TFI operates as a trucking business and things are shipped, and they work with customers who buy goods from China, I mean, you can imagine that there's just going to be less business in the next quarter or the current quarter.
And you're definitely seeing that. But I think what TFI has always done a great job of is in bad times, I think they're able to make a lot of free cash flow, because I think their whole business model is set up in a way that they can pull back on capital spending, like investing in new trucks or whatever in bad times, so that they are generating cash flow and to be able to make it through to the other side. And I think we've seen that in 2008. We saw that in 2020. We're seeing that today. I think, at the end of the day, for the stock to really work from here, you're going to have to wait for the shipping environment to get better.
Yeah, but this is a company in your portfolio where if the economy really recovers, this is going to be one that's going to earn a lot of money, right? Whereas if you bought a defensive name like, I'll throw out Pepsi
Yeah.
today, right? Where its earnings are maybe structurally depressed going forward. Whether it's risks from Ozempic, whether it's too much pricing that they took.
Yeah.
What is a bag of chips now? $8, right? It's gone out of control, right? So customers are trading down. Maybe fewer customers are buying. Maybe fewer people are drinking soft drinks. My kids don't drink soft drinks anymore. When I was a kid, my sister and I drank soft drinks, and look at me now, I'm screwed up. So fewer people are drinking these things.
Using Ozempic yet?
No, I'm okay now. I switched to diet. So the point I'm trying to make is when we're talking about portfolio management, everybody's going to notice the stocks in your portfolio that are down the most, but few can recognize that some of those that are down the most can be the best winners in a recovery. And if you cap those off, you cut them off at the knees when times are bad, you're causing a problem to the portfolio. You can't just switch your portfolio from names that are only going to work in a downturn and buy those names when the downturn has already started. You're way too late.
Yep.
Anyway, we talked about that. If you want to listen to our strategy, please listen to the last 2 podcasts we did on market volatility and the tariffs. I think we articulated very well why we don't switch our portfolio every 2 seconds based on the weather.
Right, and that's why we own TFI, which hasn't been doing very well, but that's why we also own Netflix, and that's why we own Waste Connections. And these are businesses that are, they're just different.
Yeah.
They're operating in different environments, right? And
did you have a chance to listen to the entire or read the entire for TFI?
Yeah.
So Lane Bedard, the CEO, is usually pretty. He doesn't pull any punches.
No.
Any interesting notes this time around?
Well, I think the one thing that he noted was that the TFI, a key part of TFI's growth historically has been to make acquisitions. That's how they grow, right? And they said today, because they think the stock is so cheap, they're not going to do much big M&A this year because they think their stock is attractive and they want to buy back their own
that
stock.
makes perfect sense, right? So the stock is trading about $110, $120 a share. Probably this year is going to earn, I don't know, at best $5 US. So still very, very profitable. Stock's trading at, I guess, 78 US. So not trading at a very high valuation. At the best of times, TFI earned over $8 a share in earnings.
Yep.
And what's TFI doing now? Buying back as much stock as it can. So when things do recover, even if it gets back to that $8 level of earnings, well, if that happens in 2 years, hopefully there'll be a lot fewer shares outstanding. So it could earn $9 a share or $10 a share.
And they can do that because they have so much free cash flow, even in bad times.
Even in bad times. So this is one where, let's not get too upset over it. It could go lower, but this is also one that we feel really confident when freight market does return that it's back to a $200+ share stock. So we're licking our wounds, but we're buying more.
You want to talk about Netflix?
Yeah. So let's talk about companies that seem to be tariff free from impacted. And Netflix, we're not here to, humble brag. What is it? Dunk on anybody.
Yeah.
It's just one that we've owned for a long time. The volatility has been incredible. We started buying it during the COVID pandemic.
I think before that.
A little bit before. It went straight up, it went straight down, it went straight up again. And, this is one where you could have easily let the stock price dictate what's going on when the stock fell to 180 a share in 2022. You could have said, "Oh, this business is over," without thinking like, are you going to cancel Netflix? Are you going to watch more Disney or Amazon Prime? That's not going to happen, right? Or maybe it will, but you're not going to cut off Netflix. And I guess that's what people figured out, as well as Netflix did a lot of big improvements in its business.
And famous investors were selling at the bottom.
Yeah,
too,
well,
right?
it's famous.
So
That's
why you have to do your own work.
For sure.
Right. But anyways, I think Netflix, maybe not surprisingly said there's not really any impacts from tariffs or any of the any impact from retaliation or anything against U.S. companies around the world. People are still watching Netflix. Yeah. People are still paying for their subscriptions. And I think the interesting thing is that because they added the ad-supported tier, which is, I think it's only $7.99 in the US, that even if there's a long and deep recession, it won't impact Netflix. It might even benefit Netflix because it's such a cheap price point. It's like, to your point, it's like the price of a bag of chips now.
Yeah.
For a month of Netflix.
Yeah. And like, why wouldn't everybody get that?
Yeah. And so you're much less likely to cancel your Netflix subscription for $8 a month versus canceling your trip to the Bahamas, right? And so they think that in bad times they might actually benefit from what's going on.
Two shows that I recently watched on Netflix are Primeval and Adolescence. Highly recommend them. Very interesting watches.
I think the most interesting part about Netflix's earnings was that I think a couple of days before their earnings release, somebody accidentally leaked that an internal Netflix memo that talked about their plan through 2030 to double revenues and to triple profits
from today's levels.
2024.
Okay.
From 2024.
Okay.
And
so double revenues and triple profits over a 6-year period.
Yeah. Which is, it's not that bad.
That'd be fantastic. Yeah.
And the way
that's like a 15% compound for low double digit returns.
And it's not even like, it sounds like a lot, but it's actually not even like that controversial of a thing to say, because all that really assumes is the similar rate of growth that Netflix has had historically. I think they have about 300 million subscribers today. If you do the math of what they need to get to their 2030 target, I think they have to add about 100 million subscribers, and they have to raise pricing by a couple bucks, right? So it's not like they have to triple pricing to get there, right?
Do you think that one day Netflix will have a even higher premium tier that includes more live sports or better video games or streaming from video games? Is that a potential?
Well, we didn't even talk about their gaming strategy because they have been doing I think they've made some pretty interesting. They're doing some pretty interesting things.
You have to see their
strategy there.
The first Black Mirror episode, season 7, where they talk about this company that has special tiers for its membership. It's just it's funny that the show's making fun of Netflix, but it's true.
But if you compare Netflix and what they're doing with the service, the way they just announced that I think all their shows now are going to be auto dubbed into whatever language you want. Well, not whatever, but most of the common ones.
Are they using AI to do that, or
they didn't? Yeah, I would imagine so. And automatic subtitles for all the shows that you want, right?
Lots of people are watching shows with subtitles, right? Whether it's
I think about half.
Yeah, it's not just people who have trouble hearing. It's maybe some people are also paying attention to their phones at the time, or it's in a language where the accents aren't clear. Also, people are saying that their TVs don't have good enough speakers.
Yeah.
So they're not. There's a lot of mumbling going on that's being caught.
No, and I think this is one of those things that it's not immediately it's not gonna make a difference to Netflix's profits like this year or next year, but it's all these little things that they're doing that none of their competitors are doing.
Well, they can't. They don't have all the other competitors have a serious problem.
Yeah.
Well, Amazon doesn't, but the serious problem they have is they have legacy cable business attached to them.
Yeah, and so Netflix just pulls further and further ahead of everybody else, and I'm not. I think even today, I'm not inclined to sell the stock at all.
Why would we sell the stock if there's any chance of it tripling its profits over the next 6 years? I assume that the company will be generating an enormous amount of free cash flow, buying back stock, could even start a dividend. We don't know.
Yep.
Probably won't start a dividend if it expects this kind of growth, or is going to try to get this type of growth. So Netflix, not surprisingly, Ernest, our best performer this year, I think.
And last year.
Yeah. That and Topicus, no tariff impacts, and probably one of the best businesses the world has ever seen. So that's a good example. Before we go away, let's talk about two financial services companies that also reported, Moody's and MSCI. Just from a simple observer, not even looking at the financial statements, listening to the conference call, I mean, these companies reported just staggering top line growth,
Yep.
right?
Well, 10%.
10%, right?
Yeah.
You know, it's not so easy to find companies growing organic revenues at 10% a year.
No, it's not.
Yeah.
No, that's definitely true.
Yeah. So good results. Moody's is, as everybody knows, is in the credit rating business, as well as it sells proprietary software for financial services companies. MSCI, very similar financial data for companies, financial services. Obviously, not much of a tariff impact for their businesses, but if the economy weakens and the stock market's volatile, it may not be so good for companies looking to issue bonds and companies looking to spend more money on MSCI or Moody's analytical products.
Yeah, so they're a little bit different.
Yeah.
I think Moody's is probably going to not have a great year relative to 2024 because I think if we look back over the last, I want to say since before COVID, right? 2019 was a relatively normal year in the world. I think given everything that's happened since then. 2020 and 2021, companies issued a lot of bonds because
rates were
low, and they needed to, and equity markets especially were very supportive of raising money, right? Then in 2022, rates soared and no one raised money at all.
Nope.
Especially because everybody already raised money in the last couple of years. And so 23 and 24 was basically a reversal of 2022, just basically catching up what was lost in the high rate period, especially as rates started to come down.
Yeah.
And then now we get into 2025 where there's all this macroeconomic uncertainty going on. And I think the real area of weakness that Moody's expects is that companies are probably not going to be making as much mergers and acquisitions going forward.
Well, there's so much uncertainty. Who would want to buy anything today or make a gigantic merger? That being said, there's mergers happening today. UPS bought Andlauer
Healthcare.
Yeah, it's a trucking company. Two trucking companies merging,
TFI bought two companies in the first quarter.
So for those that are generating the free cash flow, still do it. But no question, I think also a lot of private equity might be slowing down as well. And I don't know if does that hurt Moody's and
no. So that hurts Moody's because every time a company has to issue a bond to make an acquisition,
fair enough,
they make money on that, and so that's probably going to go down a little bit.
If you're paying attention to our podcast, you know that businesses are cyclical. Things like that this is how it works. But what we're looking for is long-term compounding. What is Moody's doing year in, year out to try and make its business better, and how is it allocating capital to compound your returns?
Well, I think the key thing about Moody's is that, I think most of the bond issuance that happens year in and year out is refinancing of existing debt.
Yeah.
And so if you issued a bond in 21 that matures in 2025, you're going to have to issue a new bond to replace that or pay it off in cash.
Yeah.
Right?
These companies don't have, unless you're the big techs, they don't have tons of billions of dollars just sitting there to pay off debt.
And rates are lower today.
Yes.
Than they were in 22 and 23.
And presumably we'll see what happens with tariffs.
Yeah.
But, in the last few months, we've seen inflation really come down or at least stabilize, right? And so interest rates are actually quite restrictive given where inflation is. And many expect rates to come down. But of course, these tariff worries throw a wrench into that issue there. So, okay. And MSCI?
So MSCI, I think they said they're actually benefiting from the volatility that's happening today because for a very long time, and maybe deservedly so, U.S. stock markets have outperformed the rest of the world.
Oh, yeah.
Yeah. And that's actually been a bad thing not bad, but like a modest negative for MSCI because most of their indices that they make are indexed for markets outside of the U.S.
Yes.
So the flagship MSCI All World Index measures like the global stock market index, right? Which, whereas like the S&P 500 is, obviously focused in the U.S.
True.
And so as there's been a lot of buzz about institutional investors reducing U.S. equity allocations given what's happening with the tariffs and with the economic uncertainty, and investing in like markets outside of the U.S.
I mean, all you have to do is look at the index performance of the U.S. markets versus international markets this year. And international markets are actually doing quite well. Some of them are up 7, 8, 9, 10%. They pulled back in April, like everyone, thanks to the tariffs, but that's a good thing. So if you're now looking to get exposure to non-Magnificent Seven stocks, and someone launches a hedge fund or a ETF to take advantage of that, they're going to have to, they won't benchmark it to the S&P 500. They benchmark it to the MSCI index, right?
Yes.
And so we could imagine MSCI getting more business that way. Of course, on the other hand, tough markets lead to financial services maybe looking to cut costs and not issuing as many funds, and hedge funds not starting. So it isn't going to be the best year for MSCI, but I think it reaffirmed its guidance and still should grow anywhere from 8 to 10% on the top line this year.
Right. I think the one area that they said was especially weak is that I think a lot of firms are, especially in the US, like mutual fund companies, ETFs, they're not really interested in launching so quote unquote like sustainable funds or ESG friendly funds anymore.
Yeah.
And I think a lot of that's given maybe the political climate as well. But like you pointed out, like big picture, still growing 10%, right? So can certainly be
maybe
worse.
they'll start launching the unwoke funds. And, you never.
Yeah.
We always have to remember that Wall Street, Bay Street, whatever you name it, they are in the moving business. They're not in the storage business. They're looking to sell you whatever they can, whatever product they can at the highest price. And if that doesn't work, move on to the next. So volatility is not necessarily such a bad thing for a lot of financial services companies.
That's why I always found it funny when people made fun of Larry Fink, like the BlackRock CEO, for when it was popular to be woke, he was woke, launching ESG funds, and then now he's like pulling back on that.
Of course.
What do you want him to do? He's a bond trader, right? Like he's not a social activist.
If it moves, shoot it. I mean, that's the entire business. We're old school here. We do our own research. We don't launch hot products. We buy boring blue chip companies, and that works for us. But if we had a different owner or a different profit motive, we would probably be launching new products to our clients all the time, right? Oh, that's not working. Well, let me try this.
Yeah.
It just so happens we just launched a brand new German, what's everybody buying now? The German defense companies?
Yes.
Yeah. I've had clients reach out to me about buying German defense companies. Okay, whatever.
Well, we can
buy whatever we want, but we're not going to launch a German defense company ETF, I don't think.
Not yet.
No. So any other insights that you got from the companies before we take off?
Yeah, I think one thing I want to say is that I think it's a bad idea generally to focus too much on headlines. So, for example, last week, maybe even over the last couple of months, there's been a lot of headlines about how Amazon and Microsoft, like they were pulling back on AI spending for data centers, right? And I think there's been some of the stocks of companies related to data centers, like some of the companies providing cooling, like maybe providing some of the cables, like they've fallen because of this reporting that they're cutting back. But then like we'll see what they report next week, but we'll see what Microsoft and Amazon report next week. But some of these companies came out and said, no, we're not seeing any drop in demand. We're not going to talk about the rumors that you guys are reading about. So
don't get your research facts from Twitter.
Right. Yeah. That's a perfect way of saying what I was trying to say.
Very good. So we'll have a bunch more companies reporting. I think Google's reporting tonight. That'll be interesting. And then next week, a slew of companies. So we'll get more color, more insight as to what companies are seeing boots on the ground. Instead of trying to predict what's going to happen tomorrow with tariff rates and what Trump's going to say. More important is, can our companies adapt? Can they figure it out? Are they going to be forever impacted by this regime change that some are calling, or is it, that's not no regime change whatsoever, and this is a temporary solvable issue? And how are our companies make sure they come out of it even bigger and better? And so that's what we're trying, the insight we're trying to get. And so far, I think we've gotten some pretty good insight from our companies on the ones that released earnings. So with that, and I think we'll take more of your questions. We're looking to do another mailbag episode. So I'll be posting on Twitter, asking for your questions very shortly for us to answer if you have any questions. Hopefully they're not tariff related. And with that, we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.